Okay, let's unpack this. If you have opened your portfolio app anytime in the last 48 hours, I guaranteed you didn't keep it open long. You probably slammed it shut, flipped your phone face down, and just started looking at a wall for a minute. Because yeah, it's ugly out there. Sea of red. We're talking about Bitcoin sitting roughly 45% down from its all-time high. The panic is palpable. Forums are on fire. Feeds are in meltdown mode. It feels like just yesterday we were crowning this asset of the decade. And now, people are getting liquidated overnight. Brutal doesn't even begin to describe it. But let's get some perspective. Because when you talk about percentage drop, the number doesn't really hit until you connect them with the real dollar figure. Let's talk about Michael Saylor, the man who basically turned MicroStrategy into a Bitcoin vault. He controls around 3.4% of Bitcoin that will ever exist. That's mind-blowing. And right now, on paper, he's underwater by more than $6.5 billion. Billions with B. So yeah, the headlines are screaming. End of the experiment, and let's pack it. But here's the thing, once you start actually dig into the data, this whole crash starts looking a lot less mystical. Because this isn't just panic selling, it's mechanical. There are gears turning behind this, and today, let's break down those 5 catalysts driving this chaos. Catalyst 1. Risk-off mode. In the macro world, risk-off mode is investors look around, see inflation risk, rising rates, geopolitical tension, and then they pull their chips off the table. Money flows out of speculative assets like crypto. Right now, there's an added twist, fear of an AI bubble. Big institutional algorithms treat crypto and tech as one of the same, high growth, high risk. So when Nvidia sneezes, Bitcoin catches a cold. Catalyst 2. The strengthening the dollar. Ironically, Bitcoin was supposed to protect you from a weak dollar, the hedge. But in the short term, logic flips on its head. When the dollar strengthens, there's less incentive to hold Bitcoin. Your cash is holding its value, so you don't need the hedge. People sell the hedge. Liquidity dries up. Simple as that. Catalyst 3. The ETF death spiral. That's the word you'd never want to hear near your life savings. But it's real. Here's what's happening. When you buy a Bitcoin ETF, the fund has to go out and buy real Bitcoin to back it. Great on the way up, but when people sell those ETF shares, the fund is forced to sell Bitcoin. The drop causes more ETF holders to panic sell, which forces more selling. You get a feedback loop, an automated self-destructed sequence. It's selling pressure turned into a machine logic. Welcome to algorithmic fear. Catalyst 4. The news vacuum. For 18 months, we've been spoiled with positive news, ETF approvals, adoption rumors. Now the tank is empty, and the market hates silence. Throw in the political uncertainty and stalled regulations, and there's nothing left to fuel optimism. Gravity takes over. Catalyst 5. The loss of conviction. This one cuts deep. For years, people called Bitcoin digital gold, but in 2025, gold roses 50% and Bitcoin fell 7%. That divergence shatters the narrative. If Bitcoin behaved like a tech stock on leverage, not a stable story of value, the faith cracks. And when faith goes, liquidity follows. Now zoom out. This isn't new. Bitcoin has crashed before. Way worse. 2011, 99% down. 2013, 83% down. In 2018, it was down 83%. In 2022, it was down 74%. Right now, it's just 45%. Historically, that's not even that average bottom. And every time the pattern repeats, euphoria, panic, despair, recovery. It's the crypto cycle of life. Some even predict if the 4-year cycle holds, the next low could hit around October 2026, which means you might have a long, cold winter ahead. Now let's address the monster, the doomsday fear. People whisper about Michael Saylor's margin call. Not true. His loans are structured as long-term notes, not leverage position. He can hold through anything. Then there's quantum computing scare. Valid someday, irrelevant today. The tech doesn't exist yet. and Bitcoin could evolve to defend itself when it does. What should actual investor do right now? The answer is boring. But boring is good. 2 rules: position sizing and dollar cost averaging. In plain English, don't bet the farm. Just buy slowly, regularly. Keep it to 5 to 10% of your portfolio. Enough to benefit from outside, small enough that a crash doesn't ruin you. The pros says is best. Discipline matters more than conviction. Position sizing matters more than price target. Consistency beats timing. This market is not about getting rich tomorrow. It's about surviving long enough to participate in the recovery. And survival means staying calm when everyone else is losing it. We've been here before. The story never changes. Only the names and the headlines do. The volatility isn't a bug. It's the sound of the market figuring itself out. So before you check that portfolio again, maybe just take a walk, breathe, and remember, boring is good.